This was Real Panic, Wall Street Crashes by Jonathan Norton Leonard and Mr. Flaherty. The U.S. economy expanded greatly in the 1920s, during which the gross national product increased by 40%. But as production and employment slowed in the late 1920s, the stock market continued to rise, fueling the great bull market of the 1920s. Speculators hoped to make enormous profits with little investment of real capital. In early 1928, the Dow Jones Industrial Average, an average of the stock prices of major industries, had climbed to an all-time high of 191 points. By Hoover's inauguration day, March 4, 1929, it had risen another 122 points. By September 3rd, the Dow Jones average reached an all-time high of 381 points. Rising stock market values dominated the news. After a peak in September, stock prices fell slowly. Some brokers began to call in loans, but others continued to lend even more. On Wednesday, October 23rd, the Dow Jones average had dropped 21 points in an hour. The next day, Thursday, October 24th, worried investors began to sell and stock prices fell. Investors who had bought General Electric stock at $400 a share sold it for $30 a share. Again, business and political leaders told the country not to worry. President Hoover maintained that the nation's business is on a sound and prosperous basis. To stop the panic, a group of bankers pulled their money to buy stock. The action stabilized prices, but only for a few days. That night, Monday, October 28th, Wall Street was lit up like a Christmas tree. Restaurants, barber shops, and speakeasies were open and doing a roaring business. Messenger boys and runners raced through the streets, whooping and singing at the top of their lungs. Slum children invaded the district to play with balls of ticker tape. Well-dressed gentlemen fell asleep at the lunch counters. All downtown hotels, rooming houses, even flop houses were full of financial employees who usually slept in the Bronx. It was probably Wall Street's worst night. Not only had the day been bad, but everybody down to the youngest office boy had a pretty good idea of what was going to happen tomorrow. The morning newspapers were black with the story of the Monday smash. Except for rather feeble hopes that the great banks would step into the gap, they had no heart for cheerful headlines. In the inside pages, however, the sunshine chorus continued as merry as ever. Bankers said that heavy buying had been sighted on the horizon. Brokers were loud with technical reasons why the decline could not continue. It wasn't only the financial bigwigs who spoke up. Even the outriders of the new era felt that if everyone pretended to be happy, their phony smiles would blow the trouble away. New York Mayor Jimmy Walker, for example, asked the movie houses to show only cheerful pictures. True Story magazine, currently suffering from the delusions of grandeur, ran full-page advertisements to many papers, urging all wage earners to buy luxuries on credit. That would fix things right up. McGraw-Hill Company, another publishing house with boom-time megalomania, told the public to avert its eyes from the obscene spectacle in Wall Street. What they did not observe would not affect their state of mind, and the good times could continue as before. These noble but childish dabbles in mass psychology failed as utterly as might have been expected. Even the more substantial contributions of U.S. Steel and American Can in the shape of $1 extra dividends had the same fate. Ordinarily, such action would have sent the respective stocks shooting upward, but in the present mood of the public, it created not the slightest ripple of interest. Steel and Can plunged down as steeply as if they had canceled their dividends entirely. The next day, Tuesday, the 29th of October, was the worst of all. In the first half hour, 3,259,800 shares were traded, almost a full day's work for the laboring machinery of the exchange. The selling pressure was wholly without precedent. It was coming from everywhere. The wires to other cities were jammed with frantic orders to sell. So were the cables and radio and telephones to Europe and the rest of the world. Buyers were few, sometimes wholly absent. Often the specialists stood baffled at their post, sellers pressing around them and not a single buyer at any price. This was real panic. It was what the banks had prevented on Thursday, had slowed on Monday. Now they were helpless. Reportedly, they were trying to force their associated corporations to toss their buying power into the whirlpool, but they were getting no results. When the closing bell rang, the great bull market was dead and buried. 16,410,000 shares had changed hands. Leading stocks had lost as much as 77% of their peak value. The Dow Jones Index was off 40% since September 3rd. Not only the little speculators, but the lordly, experienced big traders had been wiped out by the violence of the crash, and the whole financial structure of the nation had been shaken to its foundation. Many bankers and brokers were doubtful about their own solvency, for their accounting systems had broken down. The truth was buried beneath a mountain of scribbled paper, which would require several days of solid work to clear away. The market recovers by December.